Here we're going to go through accounting for investment in a subsidiary company using the equity method. Now for this equity method, the parent's income is going to be based on their percentage of ownership here in the subsidiary company times the subsidiary's net income. And it's going to be reduced by the percentage of any losses incurred by the subsidiary, and it's also going to be reduced by any percentage of dividends declared by the subsidiary. So we'll go through an example. Okay, here we're going to go through a consolidation using the simple equity method, and we're going to follow through here with our example using a consolidation worksheet and how we'd make our adjustments to this worksheet here to adjust for the consolidation here of the subsidiary with the parent corporation. So the first thing we have to look at is our investment account here that we have for the subsidiary here, a subsidiary S, and Corporation P has a $306,000 investment here, but that's based on the end of the year figure here of 12/31. And our equity accounts here are for the subsidiary are based on the January 1st of the year of X1 here. So what has to be done here is this: an investment account here and the equity account here have to be at the same point in time. So we have to adjust this investment account back to the first of the year, or January 1st of the year. Okay, our investment in the sub here on the end of the year on 12/31 is sitting at $306,000, and we have to bring it back here to $270,000 at the beginning of the year, or January 1st of the year. Now how it got to $306,000 here was the fact that the parent got a 90% of the income of the subsidiary for the year of $60,000, and 90% was $54,000. So we debited that investment for that amount. And then the sub also declared a dividend of $20,000 for the year. So the parent got 90% of that, or we'd credit our investment here for $18,000. So bring this back here to 270, we'd take the $54,000 here income amount here, the debit amount here, and we'd credit our adjustments here to an investment in sub for $54,000, and then the balancing amount here we go to subsidiary income for $54,000, and then the $18,000 dividend here, the credit here, we would debit our investment in the the sub here for $18,000, and then the balancing amount here we go to dividend declared for $18,000. So by reversing out these income and dividend amounts here, we've brought this $306,000 amount back to $270,000. Alright, our other adjustments here are going to come off our distribution schedule. So for our distribution schedule, the fair value of the sub we had at $300,000 here. So the parent got 90% of that, or $270,000. Non-controlling interest was $30,000. Then we have to subtract out the equity here for the subsidiary. So its common stock was $100,000, retained earnings $140,000, total equity was $240,000. So the parent would get 90% of that. So they'd end up here with $16,000 here for the book value here of the equity here. And then the non-controlling interest, they would have got 10% of the $240,000, or they'd end up with $24,000 here for the book value here of the equity. So looking at the difference here to determine excess of the fair value over the book value, we just take our total equity here assigned, subtract that from the fair value of the subsidiary, in this case $300,000 less $240,000. We get a total excess of the fair value over the book value here for $60,000. And then the parent's portion would be 90% of that, or $270,000 less the book value here of $260,000 gives us excess here of $54,000. And the non-controlling interest would just be would be 10% of that here. $24,000, subtract that from its fair value of $30,000, we end up with $6,000 here for the excess. Alright, to make our elimination and our adjustment entries, the first thing we have to do is we have to eliminate 90% here of the sub's equity against the investment account. So looking at the parent's equity here in the sub, 90% of the common stock here of 100,000 gives us 90,000 here, and then the retained earnings 140,000. 90% of that gives us $126,000. So the total amount that we have to adjust here is $216,000. So we'd go up here through the investment in the subs account here. We'd credit that for $216,000, and then the balancing entries here would be to the common stock here for the Corporation S for $90,000, and then the retained earnings amount here for $126,000. Okay, next we have to distribute this excess investment here. So for simplicity purposes, the $60,000 total amount here, that was just assigned to a building that increased in value by $60,000 for the year, and we're depreciating that at $6,000 per year here. So first, the $60,000 amount here, that would go to the building. Here we debit or increase our building for $60,000, and then the $54,000 here for the parent's 90% interest, that would be to credit or reduce the investment here in the sub by $54,000, and then the remaining $6,000 here for the non-controlling interest here, that would go to increase the retained earnings here for the sub by $6,000, or credit that amount here. And then we just have to deal with the depreciation here of the building. So we have $6,000 here that would credit or reduce the building for the sub, or for the year here of $6,000, and then the building depreciation expense here would be debited here for $6,000. Okay, now we're going to look at how we allocate our income. So for our consolidated income statement here, we had revenues of $360,000, expenses here of $220,000, and then the building depreciation expense was $6,000 here. So our total consolidated net income here was $134,000, and we're going to allocate $5,400 here to the non-controlling interest, and then the balance here is going to go through the controlling interest for $128,600. So here we're going to look at how we're going to go back and we're going to reference how we calculated these amounts. Okay, now we'll calculate our income here, and we're going to do that through an income distribution schedule here. So first, looking at Corporation S, or the subsidiary here, they had revenues of $160,000, expenses here of $100,000. So going to our income distribution schedule here, we have internally generated net income of $60,000 here for subsidiary, or the Corporation S of the subsidiary, and that's the difference between the revenues and the expenses here. And then we have to adjust our net income here, and that would be reduced here by $6,000 for the depreciation. So our adjusted net income here would be $54,000. So the non-controlling interest share, that would get 10% of that. So that would amount to $5,400. So the non-controlling interest here would be for the consolidated income statement would be $5,400. Now to calculate the income here for the controlling interest, that would be for the parent corporation, or in this case Corporation P. They had revenues here of $200,000, expenses of $120,000. So going down here and looking at our income distribution schedule, we had internally generated net income of $80,000. The difference between here, the revenues of $200,000 and the expenses here of $120,000. And then they also received 90% here from the subsidiary, or Corporation S in this case, of their adjusted net income. So in that, we had calculated that to be $54,000 up here. So the 90% of that gives us $48,600. So adding the internally generated net income of $80,000 plus the 90% here of the adjusted net income here from the subsidiary, we get a controlling interest here income of $128,600, and that's what would be included on the income statement. All right, one last look here for a consolidation worksheet here. The consolidated income statement, the non-controlling interest, the controlling interest here for the retained earnings, and then the consolidated balance sheet.